Hi, I'm Kurt Gerhardt, CEO of 21st Services. Following 6 months of groundbreaking data analytics, we announced today significant advances in our life settlement mortality tables and underwriting methodology. These advances will impact the life expectancy estimates we issue for the life settlement market. For those who do not know me, I joined 21st Services in May of 2012 from Credit Suisse, where I was a managing director in the longevity markets group. Since arriving at 21st, we've invested significant resources in analyzing our vast life settlement data set. The goal was twofold. First, find ways to improve our current underwriting methodology and tables. And second, to ensure that we have the tools available to quickly respond in the future to any changes we see in the life settlement population. In the past, we, like the insurance industry, have aggregated years' worth of data before implementing refinements to our underwriting. Think, for example, about the Society of Actuaries Valuation Basic Table changes, 2001, 2008, and one expected in 2014. We are not going to follow that model going forward. Equipped with the tools we now have, we will take a new approach going forward that will provide life settlement investors with the information they need to succeed on a much more real-time basis, through transparent and periodic updates to our mortality tables and underwriting as the data warrants. 21st Services is making these advances with the full support of our private equity owners, Boston Ventures, and Genstar Capital. We are very fortunate to have their backing and a forward-looking board that includes a former CEO of CNA Insurance Companies and a former CEO of Marshall & Swift, a public company that provides data to the P&C insurance industry. Today, 21st Services provides independent advisory services to clients in the life settlement industry. Our service offerings include data and portfolio analytics, providing clients access to our vast mortality database and tools for analyzing policies and portfolios, medical records and prescription drug retrieval, providing a cost-effective method for obtaining updated medical information on insureds, independent life expectancy estimates for use by policy sellers and investors, pre-acquisition advisory and diligence services, helping clients identify anti-selection, impairment concentration risk, impairment volatility in portfolios, as well as any title or origination issues. And with our addition of an experienced team of over 30 experienced servicing professionals in May of 2012, we offer full portfolio servicing and advisory services, helping clients service longevity assets, minimize funding costs, de-risk portfolios, and identify any issues in portfolio composition that may impact expected performance. The remainder of this presentation focuses on data and life expectancies. For the life settlement industry to thrive, both policy sellers and investors need confidence in life expectancy underwriting. The first step is having mortality tables that reflect the mortality experience of the life settlement population. Let me give an example that will help illustrate the importance of having the right mortality table as a starting point. If I asked an actuary to predict the mortality of a standard 75-year-old, I would get a puzzled look. The World Health Organization has 191 country tables. What table would you pick? If we know that the 75-year-old lives in the U.S., we could use U.S. population tables so we'd be more accurate. Now, if we know that the standard 75-year-old is male, then we would be even more accurate using this U.S. population table for males. More information, the 75-year-old male recently acquired a life insurance policy. We would look at the U.S. insurance tables for the most accurate answer. In our business, we need to accurately predict the mortality for a standard 75-year-old male accessing the life settlement market. Prior to 2008, we relied significantly on insurance tables with some educated adjustments for the life settlement population. In 2008, we relied primarily on data 21st Services aggregated through underwriting insureds from 1998 through 2007 to develop mortality tables for life settlements. At that point, our database had approximately 50,000 lives. Today, we have nearly 90,000 lives and over 8,400 observed mortalities, significantly more older age mortality experience than was available to the actuaries who created the 2008 valuation basic tables for use by the life insurance industry. One thing we did not have in 2008 was information on which lives in our database actually sold their policies in a life settlement transaction. For an example, an insured may have obtained a life expectancy quote, but never decided to sell their policy. Thanks to a number of industry brokers and providers, we were able to obtain data on approximately 20,000 lives that we know settled their policies, and we've been able to compare that performance to our overall database to measure the differences. In other words, this data allowed us to truly understand the anti-selection in the life settlement population. We also examined our data to see the differences in performance in secondary market lives and those trading in the tertiary market. These differences are likely driven by the wearing off of anti-selection that occurs when a person sells their policy in the secondary market. As we analyzed the data to develop our new mortality tables, something in the data caught our attention. Here's a quote from an IBM Data Researcher. "The key is to let computers do what they are good at, which is trawling these massive data sets for something that is mathematically odd. And that makes it easier for humans to do what they are good at, explain those anomalies." There's a clear difference in the mortality experience of lives that we underwrote for the first time from 2005 to 2008. This coincides with the era of premium finance and beneficial interest transactions, and seniors taking out policies with a view to resell them in the secondary market. This population experienced lower mortality than our pre-2005 population and the post-2008 population, especially in early durations. When we developed our new mortality tables, we needed to make certain assumptions about the current lives accessing the life settlement market. We could have taken the average of our early mortality experience and our more recent experience to develop tables. There's a joke, however, about a statistician with his head in the freezer and his feet in the oven. On average, he's the right temperature. Well, we know using the average is not going to provide the right answer. Our new tables are tilted toward the experience we have seen from 2005 to 2011. However, if the types of insureds that access the secondary market are completely revert to the types of lives that access the secondary market from 1998 to 2005, our life expectancy quotes may be conservative from an investor's perspective. Although we don't have enough data at this point to say that there has been a definitive reversion to the type of mortality we saw in pre-2005 lives, we have noticed a trend in that direction over the past couple of years. In other words, we are starting to return to higher mortality in secondary market lives, particularly in the early durations. This could be a reflection of the fact that there are now very few premium finance and beneficial interest policies entering the secondary market, and lives associated with those types of policies are what caused the anomaly in our data. Next, as mentioned previously, we identified and analyzed 20,000 settled lives. Although the sample size is smaller than our overall database of 90,000 lives, we noticed clear indications of lower mortality, again, particularly in early durations. Thus, notwithstanding the smaller data sample, our tables assume higher anti-selection for settled lives than we see in our overall database. Next, we altered our IBNR assumptions. Previously, we had an IBR assumption of 7%. This was based on the Social Security Administration's stated error ratio of 6 to 9% for its death master file. After reviewing servicing data from 21st Services and other industry participants, we believe that the types of lives that are in our database, generally higher socioeconomic class seniors, are likely to have lower error ratios than the 6 to 9% provided by the Social Security Administration. Our new assumption of 3% is much more conservative from an investor's perspective. There are new issues with the Social Security Administration Death Master File, but those are beyond the scope of this presentation. We see clear differences between secondary market and tertiary market lives. We view secondary market lives as those where the insured is in the process of settling their policy or recently settled their policy, call it within the last 2 or 3 years. Our standard life expectancy quotes now reflect the impact of greater anti-selection that we've observed. Of course, as a policy ages in an investor's portfolio, the anti-selection naturally wears off. We are introducing today what we refer to as tertiary market LEs. Although tertiary policies have more anti-selection than we see in our overall database, the tertiary LEs will have lower anti-selection than is seen in our standard LEs. We caution that these LEs are not ideal for all tertiary policies. The more time that a portfolio or policy has aged, the more appropriate the tertiary LE will be. We generally don't know if a life we are underwriting is associated with a policy being shopped in the secondary market or a tertiary policy that sold 2 years ago or 8 years ago. For clients who want to more precisely determine anti-selection assumptions that should apply to their specific policies and portfolios, we can analyze the policies and portfolios versus our database to develop appropriate assumptions. Having good mortality tables is one key to accuracy. The other key piece is underwriting, referred to by many as the credit and debit process. Our underwriters, the vast majority of whom have over 20 years of life and health insurance underwriting experience, follow a manual for determining whether a factor exists that should be credited or debited. Our rules-based proprietary software system then generates the credits and debits. After the credits and debits are calculated, the insured will have a mortality multiplier that will allow us to compare the insured to the standard life in our base mortality tables. Prior to 2008, we relied on insurance industry data and underwriting principles adapted for the life settlement market to determine appropriate credits and debits. In 2008, we had substantial life settlement experience, but we did not have enough data or the tools to make adjustments to credits and debits based on individual impairments. Instead, we made adjustments based on overall level of impairment. For example, we made the same changes for all insureds with multipliers between 3 and 5, even though they may have reached a 3 to 5 multiplier for a number of different reasons, be it heart impairments, cancer, pulmonary conditions, or others. One of the most exciting breakthroughs resulted from statistical analysis on individual health impairments. With the tools and data needed to analyze specific impairments, we were able to refine credits and debits impairment by impairment, including noting differences in credits and debits for males and females with the same impairments. A handful of the key improvements to debits and credits are outlined on this slide. People with active lifestyles, which we refer to as Lifestyle A, will receive substantially more credits. Also, for the first time, we're providing substantial credits for persons with good exercise capacity. We also see that persons with a family history of certain impairments, for example heart disease, actually deserve credits if they lived into older ages, as they have likely made adjustments to their lifestyle to avoid heart disease that impacted their parents. On the debit side, we are generally providing fewer debits for heart-related impairments and more debits for aggressive cancers, cognitive impairments, and inactive lifestyle. At this point, I'll discuss a little more detail the process for our analysis and the impact of our analysis on our life expectancy estimates. The process we undertook for the improvements we announced today was multifaceted. First, we assembled our internal team and supplemented them with trusted advisors from the actuarial and medical research fields. We then set about analyzing our data and developing analytical tools that would enable us to spot important trends and measure the impact of potential changes to our mortality tables and our debit credit engine. We then developed those tables and revamped our automated underwriting system. On the actuarial side, we chose the New York office of a global actuarial consulting firm with significant experience in life settlements. From the world of biostatistics, we partnered with epidemiologists from the Chronic Disease Research Group. Both of these groups provided excellent support to our efforts. As mentioned previously, it was important to find the right data set when doing our analysis. Although we performed nearly 200,000 life expectancy estimates on over 90,000 unique lives, a small portion did not pertain to life settlements and were excluded from our analysis. We chose to focus on recent experience, post-2005. However, the most important decision we made was to seek out and rely upon settled life experience as the basis for our changes instead of that of our overall population. We further studied the differences between secondary and tertiary experience. Among the tools we used were granular actual to expected calculators, survival and regression models, and predictive survival models. We believe this to be the most extensive undertaking in the life settlements arena. By not relying in total on the backward-looking actual to expected analysis, we believe we obtain a much better result. Because of these stratified data sets and powerful tools, we were able to extract the performance of settled lives versus other lives in our population that for whatever reason did not sell their policies. It has long been agreed that anti-selection occurs in the underwriting process, and there were theories about a second level of anti-selection by those who actually sold their policies. We feel that we have identified the second level of anti-selection. This is a result. The result is our base table that represents the overall life settlement database with a separate table that reflects modifications due to the greater anti-selection in settled lives. Additionally, we updated our annual mortality improvement study based on U.S. population and are happy to report that our tables no longer contain even the slightest resemblance to life insurance tables such as the 2008 VBT. We applied these tools not only to our mortality tables, but to the underwriting process as well. When we last implemented changes in 2008, we made debit credit adjustments at the level of overall impairment because of our data limitations. This time around, we were able to study each individual impairment and its effect on mortality, both independently and in conjunction with other impairments and conditions. We saw that conditions such as lifestyle and obesity acted more like continuous variables instead of discrete conditions, meaning that it was better to reflect their impairment over time rather than as a one-time or for all-time debit or credit. Another important refinement was the recognition that many conditions affected males and females differently and also lifestyles differently. The impact on our new underwriting tables and methodology varies from insured to insured. In the next two slides, though, we are providing a high-level overview of the impact. Overall, our life expectancies extended by 19%, more for males, less for females. The greatest extensions occurred at initial multipliers between 3 and 7. We saw some LE reductions for certain sedentary individuals, lifestyle C, and at the extreme high ages. By far, lifestyle A saw the greatest extensions. The next two slides compare our new tables to the 2008 BBT for male non-smoker age 70. On this slide, it is difficult to see our base mortality table, but we will get to that in a minute. You can see that we expect much lower mortality in our settled population than the 2008 BBT. It is easier to see the differences when we magnify the early durations of the curve, as you can see the distinct separation between our curves and the 2008 BBT. Further, the effect of anti-selection is seen as the difference between the red base mortality curve and the curve for settled lives. As we conclude, I want to spend a few minutes looking forward. First, I want to say that I think the future is bright for life settlements. At the basic level, the industry provides significant value to seniors as they seek additional funding sources to meet their retirement needs. As long as the insurance industry continues to offer insureds less cash value than their policies are worth, the life settlement industry will continue to meet the needs of our seniors. On the investor side, our industry, which initially attracted smaller niche investors, now counts some of the world's largest private equity firms, hedge funds, and pension funds as investors. And naturally, over the last 15 years, we and others have become much more sophisticated in underwriting, and this experience will lead to much better results for investors. At 21st, we'll continue to invest significantly in research and data analytics to further enhance our products. We are also pleased that the research underlying these refinements has been accepted by the Society of Actuaries for inclusion at their next longevity symposium. This will mark the second time in a row where 21st Services data will be included in the symposium, the previous research relating to ultimate conversion of mortality in populations. We will also provide clients access to data and analytical tools to help them better assess the value of policies. and we will continue our policy of providing transparency on changes to our tables and underwriting going forward. We will regularly monitor mortality trends and identify data that is inconsistent with our tables or underwriting. With our new tools and our commitment to ongoing research and analysis, we will be able to quickly identify any needed changes and regularly calibrate our system to reflect changes in life settlement population mortality. Finally, a key point that everyone knows, but it cannot be reiterated enough. Not all lives are the same. Our life expectancy estimates will help guide investors, but the great asset managers will continue to recognize that life expectancy estimates show the projected mortality distribution for 1,000 insureds with like conditions. How can you select the lives that are going to mature on the left side of the curve versus the right side? There are many factors that should be considered in this type of analysis, and we now have the tools and data to share with our clients to help them better select lives and analyze risk. We appreciate your time and thank all of our clients for their support. If anyone would like to discuss the advances in more detail, please do not hesitate to contact us.